Welcome back to the Noob Selling Options channel. I am absolutely thrilled to have you here today for this explainer because, well, we are looking at a truly fascinating intersection. We're talking about that collision between major macroeconomic market shockwaves and the micro, day-to-day strategic maneuvers we actually make in our own active portfolios. Today, we're going to connect the dots between a massive headline crash and the tactical, hands-on moves you can make right now to position yourself for success.
Just look at that number, minus 13%. Ouch, right? That is the massive after-hours plunge we saw recently from a true market heavyweight, Broadcom. It's a high-energy, super high volatility moment in the market right now. And hey, if you want to stay ahead of wild moves exactly like this one, do me a quick favor, hit that like button and subscribe to the channel right now so you never miss an update from us.
Okay, let's dive right into Section 1, the AVGO earnings crash.
So, on June 3rd, 2026, Broadcom dropped its fiscal second quarter earnings report. And man, this was a classic, textbook case of a stock that was priced for absolute perfection, colliding head-on with a very nuanced reality. When we break down the numbers, the growth is undeniably impressive. Non-GAAP EPS was up 54% year-over-year to $2.44, and their AI semiconductor revenue? A staggering 143% increase to $10.8 billion. That's largely driven by custom chips for giants like Google and Meta. But here is exactly where the cracks started to show. Total revenue came in at $22.19 billion, which slightly missed the $22.27 billion expectation. Plus, infrastructure software hit $7.18 billion, coming in just slightly under Wall Street's $7.32 billion estimate. And honestly, those tiny misses were all it took to completely spook Wall Street.
So you might be wondering, why did a company with triple-digit AI growth crash by double digits? It definitely wasn't a sign of a failing company, not at all. It was actually a function of four very specific friction points: an unchanged long-term forecast, extreme sell-to-news dynamics, minor softness in their core software, and physical supply chain constraints that limited immediate fulfillment. Let's break these down a bit.
The biggest drag on sentiment was right here. CEO Hock Tan kept Broadcom's long-range forecast of $100 billion in AI chip sales completely unchanged. And in today's market environment, traders are aggressively demanding continuous beat-and-raise cycles, kind of like the ones we've seen with NVIDIA. So simply maintaining an already massive $100 billion target, it just wasn't enough to feed the momentum beast.
Combine that unchanged forecast with the fact that Broadcom had completely front-run its own earnings event. In just the 5 trading days leading up to June 3rd, AVGO went on a parabolic run, surging over 13% to hit an all-time intraday high of $495. It literally added roughly $270 to $300 billion in market value before the numbers even came out. With expectations running that hot, aggressive profit-taking on any slight blemish was practically inevitable.
Now, what's really interesting about this next part is how we adapt. Section 2, the portfolio pivot.
So how do we react when the market gets this choppy? We pivot. I want to give you a true look over my shoulder moment here with some actual trade logs from our portfolio. You can see we actually liquidated positions in Meta, SoFi, and CBRS. And yes, we booked realized losses. Look at those red numbers, minus $593, minus $1148. We cleared out these stocks at a loss to raise free cash. Why? Because we need that capital ready and waiting for potential cash-secured put exercises.
Let's be real, staring at those red realized losses can be painful. But I want you to reframe that visual using a sports manager analogy. Think of your portfolio as a professional sports roster. When you liquidate a loser, you aren't admitting defeat. You are playing a highly strategic offensive game. You are cutting underperforming players to clear up salary cap space so you can sign an absolute all-star.
Which brings us to Section 3, overcoming sunk cost fallacy.
Executing a bold move like this requires overcoming some serious psychological barriers. Most market participants absolutely freeze up when faced with taking a loss to raise liquidity. It starts with a behavioral finance concept known as loss aversion. We are literally hardwired as human beings to hate losing twice as much as we enjoy winning. The average investor looks at a red position and thinks, I'll just hold it until it gets back to break even, then I'll sell. But guys, that is a dangerous emotional trap known as the sunk cost fallacy.
The amateur mindset relies heavily on that sunk cost fallacy. It treats past money spent as a guide for future allocation. It's defensive anchoring. What we are doing with a high-conviction pivot is the exact opposite. By decoupling our ego from the trade entirely, we accept a hard truth. Our capital is worth more to us today as free offensive liquidity than it is locked up in those specific underperforming tickers.
Furthermore, clearing the deck of lag and consolidating positions like SOFI and CBRS instantly reduces your cognitive load. Every single position demands psychological real estate. By cutting them, you reclaim your mental bandwidth. Instead of micromanaging 4 different trailing setups and stressing over them, your focus becomes absolutely streamlined towards your highest conviction theses and your impending short puts.
And this brilliantly illustrates the crucial shift from price anchoring to opportunity cost. The amateur fixates on past peaks, saying things like, but Meta was higher last week. The advanced trader, on the other hand, asks, is this dollar doing the absolute best job it can do for me right now? Holding a lower conviction asset just to avoid booking a loss means you miss out on the opportunity to fund a high conviction premium mega cap tech asset at a steep cyclical discount. Ultimately, you are trading a weak asset to secure a fortress asset.
Moving right along to Section 4, cash is an active option.
This brings us to a massively powerful strategic concept. In a volatile, choppy market, cash is not just idle money sitting in an account doing nothing. Cash is an active option on future prices. We call this the barbell risk mindset. Holding cash gives you the ultimate psychological upper hand. Instead of fearing a market dip because you might get assigned on your puts, you actively welcome the dip. You have the dry powder ready to absorb those shares. You literally transform yourself from a victim of market volatility into the liquidity provider who profits from it.
So, let's summarize exactly what we achieved by taking those losses on the chin. Yes, taking the hit hurts the ego in the short term, no doubt about it. But by doing so, you overcome loss aversion, you reclaim vital mental bandwidth, you maximize your opportunity cost, and you weaponize your cash as an active option. This is, for sure, an absolute masterclass in portfolio hygiene and execution readiness.
So the million-dollar question, what are we hunting next? What is our high conviction target for these cash-secured puts with all this newly freed up capital? Well, I will be updating the channel on exactly which stocks or ETFs will be targeted in the time to come. Remember, don't be afraid to make these tough cuts if it is in the absolute best interest of your portfolio. To make sure you don't miss that big reveal on our next targets, double-check that you are subscribed to the channel. Until then, ask yourself, is your idle cash playing offense or just sitting on the bench? Thank you so much for joining me for this explainer, and I will see you in the next one.